Hello everyone, today's webinar is sponsored by Admiral Markets. We will talk about stop loss, a complete guide. So today I will show you what type of stop losses you can trade. I will show you how you can protect yourself by placing other forms of stop, especially mental stop, which is very I know that many traders get involved with that mental stop and they made mistakes just because they don't know where to put mental stop loss. So I will explain three types of stop losses and show you how to do it correctly. And now I just want to present my colleague, Mr. Mikhail Onokhov, and he will tell you a few good things about trading, about platform, and he will. I'm sure that he will ensure you that you need to stay with Admiral Markets. So please bear with me after Mikhail, and you will see how you can protect your profits and equity. Thank you very much. Now, Mikhail, you can continue with your presentation.
Thank you very much, Ninat. Thank you very much for such a lovely introduction. Just as Ninat, your guest, has said, we're going to have one of the great webinars today in the evening. But first of all, just for 5 minutes, my name is Mikhail Onokhov, and I'm a Client Relationship Manager for Admiral Markets. Here you can see my email, my Skype, also my LinkedIn, and also the email of the trading camp. This is our 3-week online program that allows you to grow confident in yourself and ready to face the real market. Just as Nat said, we're going to talk about Forex and about various complex concepts. But before that, let's take a small detour, and I would like to tell you a small story. Since this webinar is dedicated to Forex trading, you will be talking a lot about various currency pairs. I would also like to discuss a pair of sorts, but a slightly different pair. I want to speak about the pair that is constantly having a battle deep within you. I'm talking about, of course, your present self and your future self, as you can see on the picture. And every single one of us have experienced this battle a million of times. When you decide to stop eating junk food, or quit smoking, or maybe put an extra 10% of your paycheck into a savings account, those kind of goals are being set by your future self. Your future self wants to look good, enjoy good health, and be financially stable and have enough money saved to buy a property or retire on a good pension. And I bet that every single one of us have failed on a lot of very good plans their future self has set up. So why did that happen? Well, the problem is that just like some smart people, future self is not very strong. He's a lot weaker than the present self, and the present self has a pair of powerful muscle hands that can buy hamburgers and french fries with all the money you wanted to save, and maybe then have a nice nutritious smoke after that. So the battle between your future self and your present self, it has been fought for 100 years and has always been extremely difficult for your future self to win. 19th century economists said on temptation that to abstain from the enjoyment which is in our power and to seek distant rather than immediate results are among the most painful exhaustions of the world. That was in 1836, and it is still true now. So if we put everything into financial context, your present self wants to spend, your future self wants to invest. So the concept of investment is not only applicable to money, you can always apply to time as well. So you're a great example right now, because instead of spending or wasting the time, you have decided to invest it and you attended this webinar. Today's your future self was victorious, but it is now very important that you invest in knowledge you're going to acquire today. Otherwise, it is going to be a sunk cost. So when the webinar is finished, you can apply the concept of investment where it truly belongs. Once the webinar is finished, you can invest your funds into an asset that you expect a capital growth. A few of you might argue that Forex is mostly speculating, but our Admiral Markets account offers you an easy and convenient way to invest into a growth of a company. You can long shares of Apple, Boeing, Facebook, or Exxon, and these are just a few examples. Or if you like, you can invest into a whole index as well. You can always long the indices such as Dow Jones, FTSE 100, or DAX. And if you're pessimistic, you can just short them and see if the market agrees with your prediction. Either way, when you invest, you're making sure that your future self perseveres. And whilst you watch your investments appreciate, So will your self-control, your discipline, and your financial stability. Thank you very much. It's been Mikhail Olokov. I will now pass the microphone back to Nat, who will continue with his webinar. Thank you very much, guys. Bye-bye.
Thank you, Mikhail. Thank you very much for such a nice presentation. So now we can proceed with our webinar, Stop Loss, a complete guide to stop losses. So let's first talk about what is a stop loss. Then the next thing will be advantages and disadvantages of having a stop loss, and third is types of stops that we use when trading Forex. So the first thing to know is what basically is a stop loss and why you should always have a stop loss. So I know that many traders trade without stop loss, and that is very wrong, because if you don't use your stop, the chances eventually be that you will lose your trade. That will surely happen, but you don't want that to happen. So that is why you need always to protect your equity by placing a nice stop loss order. So you need to know that placing a stop loss doesn't mean you will lose your trade. And I've heard many times that if you don't place your stop, the trade will eventually come to you and you will in profit. That is very wrong. There is a phrase that we professional traders use when trading Forex. The phrase is died by a death of 1,000 cuts. That means that your equity can be burnt away if you trade always with slight stop losses. That means that if you scalp, then it's okay to use a smaller stop loss. But if you make an intraday positional trade and you want to have a proper stop loss, then you shouldn't do it with very small stop loss. That can eventually lead to a death by 1,000 cuts. That means that your stop will get hit very often, and that will lose your chances to have a good profitable trade. But basically, placing the proper stop loss will limit investors' potential on a Forex position, potential loss. That means that you basically place a stop order. Translated to Forex terms, always when you let's say that you buy a pair. Let's say you buy euro-dollar, and your stop is 20 pips. When your stop gets hit, what your platform do is that automatically place a sell order. So a stop loss is a stop order. So if it gets hit, the platform reverses your position. So if you have a long position, if your order gets hit, it will be automatically a sell order into the market. Also, if you, vice versa is for shorts. If you are short into the market, if your stop loss gets hit, your platform will do automatically a buy order. You don't see that, but that is basically a hedging. And I know that many traders use hedge, but not on a proper way. Let's say that you open euro-dollar and after 20 pips of loss you open a reverse order. So you have a long and sell in the same time. That is not correct. If you want to hedge, then you go long for euro-dollar and you go short for dollar Swissy. That's an example. That's proper hedging. But what does it mean to hedge if you automatically do what the platform does for you? I think you understand what I mean. If you place a long order and you have a stop loss of 20 pips, your platform will do it in the background. It will open a sell order in the same amount as your buy order has been traded. So basically, if you open it by yourself, that is not correct. So hedging is not proper if you open euro-dollar long and euro-dollar sell. Why would you do that? You need to hedge with other dollar pair. So let's say dollar Swissy, the pair which has inverse correlation to the currency you are trading with. So basically that is the correct way to place a hedge order. So this is the right truth. When we close a sell order, it's an automatic buy into the market. You have presumed, and you probably know how to trade breakout trades. And you know when some important level gets broken, let's say today euro broke at 35.15 level, what happened is it was automatically it went 10 pips into the profit. Why? Because every sell order, or at the same time it was a buy order, it was converted to a sell order, and those sell stops were eaten. So that is what accelerates the price. Sell stops or buy stops above or below a level. That is what accelerates the move. And if you have noticed, I also told you to possibly go long around 34.80 and 34.95. So the first trade, it was 35.85 long order on euro, and it went some 15 pips in profit. But that was for today, because today we expect that Senate will pass debt ceiling decision to a president, and I think that Mr. Obama will sign that. So I can expect a further dollar strength. So we may see a bit of a selling maybe later during the day. But what is important for today's webinar? The important thing is how to place your stop losses and why you should place it. If the market is very volatile, your stop loss will experience a slippage. A slippage, probably you have experienced that quite of times if you trade when there is a strong news release. Basically, slippage means if you place your stop 20 pips, let's say that your stop is 20 pips, and there is a big news which hits your stop loss, and your stop loss gets hit for 26, 27 pips. Those 6, 7 pips or 10 pips difference is called a slippage. And that can happen when you trade the news. So always my suggestion is close your trade prior to big news. You can trade while there are some red news, some all orange news on Forex Factory, or yellow news on Forex Factory calendar. But basically, what you should try to stop looking for trades, or get out of trade when there is a big red news coming. To yesterday, if you remember, there was a zero economic sentiment for Germany and Europe, and while it was very good, the dollars went long, and euro dollar automatically went short. So we had you see, the market is not always perfect. So basically, that is one of the reasons why you should always use your stop loss. And finally, stop loss means stopping the loss. That is the proper term for stop loss. Stopping your loss. That is why it's called stop loss. There are many advantages and some disadvantages of using stops. The basic advantage of stop loss is, as I told you, that we are protecting our equity. Not using it on leverage trades can end our career in Forex market, and that is a simple and harsh truth. Especially if you use mental stop loss, and I will show later what mental stop loss is and how you should use it. And that is maybe the worst thing in using stop losses, not properly using mental stops. Quick exit of the trade when it goes below or touches the stop loss, and the peace of mind. It will give you the peace of mind. If you want to trade during Asian session, let's say, and you'll go to sleep just prior to Asia. If you have an open trade, you just can leave your trade and go to sleep. If you sleep, you need to sleep you need to sleep tightly for the next day, because you will trade possibly the whole next day, or you will work the whole next day. But if you don't have your stop loss while you sleep, guys, that can be very, very frustrating. And that can be very, very uneasy feeling. You will probably get awoken very frequently. You will check your phone or your laptop or computer while you sleep. It won't give you a nice peace of mind, nice sleep. Also, if you use your stop loss, it will give you disconnection proof. That means that you will get proofed against disconnections. So if your internet goes away or you experience a blackout while you're trading, a complete loss of electricity, your stop loss will save your day if you're not able to trade for that particular moment. So you will be disconnection proofed. Also, it can give you a platform malfunctioning proof. That means that if your platform gets frozen or gets broken by enemies, is it a virus or is it improper usage of, let's say, MetaTrader 4, or just your computer went flipped away, let's say, that means that your stop loss will protect you for sure. So you won't have to think about it. And if you use your stop loss, then be peaceful. Be peaceful. Don't be very nervous. Don't be, don't be jumpy. If you have your stop loss, then respect your stop loss. If it gets hit, okay, it gets hit. But at least you know that you have protected your equity. Advantages. That was advantages. Now let's say a few things about disadvantages. Brokers' awareness of stop loss orders. Some brokers can use the stop loss against you. And the nice thing is that I have never noticed it when trading with Admiral markets. I was trading with a couple of brokers a few years ago, and from time to time I have noticed some weird behavior. And one time we caught a broker. I cannot say the name now because this is a live webinar, so I cannot say it live. But me and my colleague caught our brokers they spiked our stop loss. And we had multiple platforms open, and we saw that stop loss has been spiked. It wasn't much. It was by 2 or 3 pips, but it was enough to clear our trade. So you can always make a sue against that broker, or you can call live support to explain you what happened, but they would need a valid proof for that strange happening. So the big thing is really when trading with Admiral markets, I have never noticed that the spikes are being hit. Even sometimes I can say that my stop loss has been missed by 0.5 pips. And that is really a welcome and very, very, so Admiral markets, very big thanks to you, and I really admire your profession. So you're very professional. I can say that now live. As really my stop loss yesterday, it was missed by 0.5 pp on a trade. So what can I say? That's just perfect. So. But if you don't want to use Admiral markets, let's say, you need to be aware that other brokers may use it against you. They may spike the stop loss, so your stops will probably get hit even if your trade is successful later during the day. Also, disadvantage of a stop loss is one of bigger disadvantages if it's placed in a wrong place or time. Stop loss should always be placed at a proper moment in a proper timing. And that means that stop loss, if you trade, for example, a daily retracement, your stop loss cannot be 20 or 30 pips. If you're trading with a daily retracement, or you want to go long on a daily candle when there is a drop down of 100 pips, you need to use at least 50-point stop. If you scalp, 50-point stop is not an option. If you scalp 10, 12 pips is okay. If you want to place intraday trade, 25, 35 pips is okay. If you go with mental stop loss, there is other thing. I will tell you how to use mental stop loss, but now we are talking basically about that technical stop. Technical stop is the most widely used stop loss of all stop losses. And maybe the biggest disadvantage is that you can experience that of 1,000 cuts. That means continuously trading with small stop loss that gets hit each time or multiple time position when position is opened. That can happen especially on ranging markets, and that can happen if you scalp too frequently without prior getting into the fundamental views for that particular market. So don't scalp if you don't know how to do it, because you may have an experience that of 1,000 cuts. There is bleeding. That 1,000 cuts will eventually cause bleeding, and that is well translated to forex market. If a warrior on a battlefield experience 1,000 cuts, he will die by bleeding. He will die slowly, not immediately. So that can happen if you continuously trade with small stops, and your stops get hit each time you open a position. So you cannot place 5 pip stop loss on any pair. That is nonsense. So if you scalp 10, 12 pips is a right stop loss. For intraday 25, 35, and for daily trades below 50, it's just not an option. Next thing what I want to talk about is types of stops. So there are percentage stop or equity stop, technical or chart stop, mental stop, and finally time or hourly stop loss. Those are four types of stops that we basically use in forex trading: percentage, technical, mental, and time or hourly stops. There is also a volatility stop, but we won't use it now just for the sake of this presentation, because volatility stop is not so widely used, and that basically have just a few things to do with ATR and Bollinger Bands. But basically, those are four basic and most usable stop losses, types of stop losses. Percentage stop use predetermined percentage of trader's account. So if your percentage which you are willing to risk is 3%, let's say that is your optimal stop loss. So you will use your stop loss just by your willingness to risk. If you're willing to risk 3%, when you open a trade, your percentage will be 3%. That means that you will have a single trade per day. If your stop loss is 3% of your account, that means that you can have six trades for each of 0.50 percentage of risk to use that percentage stop loss for the overall day. With this method, stops are usually small if trades are leveraged. So if you use a big leverage or a leverage trade, let's say one standard lot on, let's say, 10K account, that means that you are willing to risk 30 pips, and that is everything. So if you open a standard lot and you're willing to risk 3%, that means that you will have 30 pip stop loss, and that will determine that your trade is a single trade for that day. If you use 0.5 lots on 3% risk account, that means that you will have 6 trades that can go wrong before you start trading that day. Usually when we open a percentage stop, that means that there are no many entries. It's usually a single entry. So if we open one single lot on a MetaTrader 4 platform, and we use it as a 3% for our optimum risk, that means that our stop loss will be 30%. So it's a single entry for that day. That is why I always advise using for each $10,000 or euros. I advise using 0.3, 0.5, and 0.7. Because even if your stop loss is 3% for that day, that means that you can have multiple stops, multiple trades per day. So if you go wrong with 0.5, you can correct yourself with 0.7. If you go wrong with 0.7, you can correct yourself with one standard lot without risking more than you have given yourself. So let's say that 3% is optimum. Some risk 5%, but 3% is optimum. Not many traders do that percentage stop, because it's arbitrary stop loss. That means that it means that we basically are trading by arbitrage. That means that we will use that percentage just by our how can I say a pure estimation of the market. So not many traders do that. I personally do that from time to time. When I see that I have a potential good trade, I calculate the risk, and then I do it with my percentage stop. I can open 1 or 1.5 single lot and use all stop, and that will be the trade for the day. So I won't trade that day. That is the only trade. So percentage stop is a good thing if you know when to open it and when and how much of the accounts are you willing to risk. Mental stop. This is also very, very important. Using a mental stop is a combination of percentage and technical stop. It needs constant monitoring. It's usually done on big volatility and slightly leveraged trades. Traders watch price levels without entering stop loss orders on platform. That is the biggest qualification for a stop loss. Let me point this out. Traders watch price levels without entering stop loss orders on platform. Closing is done manually by babysitting the trade. Let's say this was the height, previous height for this day. And we had some consolidation, and we didn't open the trade around here. We wanted to experience a nice breakout trade profitability. This is the breakout. We went long, let's say 2 pips above this high. And I'm sure that this can happen, and this happens to you very frequently. We get filled by our order, and we are positive. We are running into the profits. We didn't close it here. We are still running, expecting that the price will go above this particular level. It doesn't matter now which chart is this, which level is this. It doesn't matter. Then what happens is you're still into your trade, but your trade from this level, your trade starts to accelerate to other side. Now it's in the profit, but you still didn't close the trade, hoping that the price will again spike above. So let's say that you have 30 pips of profit on a big leverage. Let's say that you have opened 2 lots on 10,000 account, or that you open 1 lot on $1,000 account. That is, assume that we go with a big leverage because it's a big breakout trade. Then what happens is the price reverses, it goes to break even, but eventually it breaks to the downside. Now what you should do? What should you do now? That is a very big problem for most of you. I know that. you don't know how to manage your trade. Why? Because you are over leveraged and you just don't know where to stop where to put stop loss. And now your account is 6, 7, 8% in a loss. But it still goes down. It goes down, it goes down 10, 15%, 20%. Now you need to use your mental stop. Let me advise you. You have two options. First option is to use your mental stop if your account goes 5% down on a single trade. It doesn't matter if you are 5% down in 2 minutes or it happened in 1 hour. That is your mental stop. Your mental stop should be 5% of overall account. And the better thing is, if you have witnessed, now let's say another example. Let's say that you are expecting a breakout here, but you see that the very low for that particular market was there. Let's say that this is 15-minute chart. So you count the distance between possible entry and this low. Let's say that the distance is 45 pips. Then you make a mathematically valid trade. If you're using 45 pip stop and your mental stop should be just around there, that means that you will use the right percentage for this particular trade. So if you're willing to risk 45 pip stop with a maximum risk of, let's say, 2% or 5%, it's up to you. But you have to include 45 pip stop into that 5% just to avoid the 20% possible drawdown. So that is how you use your mental stop loss. Prior to opening a trade, concentrate on your possible setup. This is the level which I want to see broken. Our stop mental is 45 pips. I'm not sure that this will go just below there. And we will open a trade with a 45 pip stop loss, which is included in our 5% risk. I will not open a trade which will give me a 45 pip stop with 20% of a loss. So the thing is that you need to always calculate a possible loss when you are trading, because trading is not about profits. When you trade, it's about protecting your equity. It's about risk. How much are you willing to risk to make the profit? Remember now what I'm saying. That is the simple and the pure truth for the Forex market. Trading is based on how much are you willing to risk. So if you open a trade here, let's say you have opened one lot, but you know that if it comes to there, your overall loss will be 15%. That's not a valid trade. You always need to have into account a possible reversal. So in this particular example, even if you use 5% with a 45 pip stop, your trade will eventually be very, very good. But you were very, very wrong if you have opened an entry here and you stop it there. That is not correct. You didn't place your mental stop loss order where you should, and you didn't place a technical stop where you should. So basically your inner self told you to close the trade because you were 10% in a loss with a single trade, and your psychology start to kick in. You must not let the psychology to kick in when you are trading. You need to calm it down. Okay? So that is why I'm saying use a combination if you trade of technical stop and percentage stop. That is called a mental stop loss. And that has much to do with psychology and with technical levels, proper technical levels. What is time stop? Well, time stop there is a good example today, is a good example of basically of what time stop is. Now I was looking at the price, euro is 35.11, so it's very, very good for that trade if any of you that open the trade on 34.85. So time stop is this. We are basically based on a predetermined time, and we can use basically a candle close. It's 1 hour, 4 hour, and daily. We also applied prior to big news and weekends. And we also applied when there is no volatility. So what is a time stop? Let's say that we were long today around 35.15. And what happened is we closed the trade here prior to big news. So we can use the stop loss there, or we can use stop loss here. So basically what we do is we protected ourselves prior to a possibly big happening and big announcement. That is when we use time stop. We also use time stops prior to weekend because we don't want to risk any news release or any fundamental shake through the weekend. That is why we also apply big stop loss. And you see 34.85, why I say that is a big level. Technical stop is the most common way of setting stop loss orders. I will talk now about technical stops, and I ask you to make a 3 or 5 minute break. Let me just do a few slides. I will prepare it and I will show you. And then please, if you have any questions, don't hesitate to ask me. I'll be just back in 3 or 5 minutes. Let's make a simple and a little break. So here I am again. I have prepared a few examples for technical stops, and I will show you on each time frame now how you can place your stop loss and how you can trade. I can see that there are no questions here, so interesting. I think that now everything is clear concerning those manual stops and other stuff. But now I will show you what technical stop is and how you can place it properly on each single time frame, including 5-minute time frame. So, technical stop is the most common way of setting stop loss order. It usually uses stronger technical levels and or swing highs and swing lows, which again fall into the category of being technical. Let's say that all chart stops are technical. So, we talk now about the most common stop loss which is used in our everyday trading. This is the picture that I have taken from the slide, but I will also show you later on each single time frame how you can trade it. So technical stop is the stop loss which is placed just above or just below the highs or lows. Let's say that we have taken a trade just below this level. Of course, you all know that your stop loss is being placed 10 pips above the last high if you are trading on 4-hour and daily charts. And this is the right thing now to show you. Let's say that we are having a daily chart here. I will clear all the old objects. Let's clear, I don't need this, and I don't need Fibonacci. So let's say that we have, and we are having here a nice head and shoulders pattern. And let's say that we want to trade it. Counter trend trade, because you know I was buying the dips from this level 35.85, and if you have attended my last webinar, I told you to buy dips towards 35.85. I also said that in my analysis for the last few days. So you see that now this head and shoulders hasn't been broken yet. But what if we want to trade it? Let's say that this candle today closes just below 35.80, just below 30. I cannot see now. Let's see the proper level. Let's say that this candle closes. I don't have a red level here, and I don't know why. 35.85 is that. If this candle closes below 35.85 on this particular day, I can say that we will go lower, but we need a strict close of this level. So if you had placed your short order here below 35.15, where would you place your stop loss? Of course, the proper answer would be to place it just above this high. The high of this is 35.67. But because we are trading on daily time frame, our stop needs to be above the most significant level for that time frame. So the most significant level is, in my case, on my trading template. This is practical naked trading template. The most significant level is 35.85, right? 35.85. So what happens is, if I go short just below 35.15, I would place my stop just above 35.85. Why I say 35.85? Because first of all, for me, that is, and I think that is basically a very important level. Also, this candle high has broken and collected some stop. This was stop grabbing, but that didn't have much power to go above. That is why this candle closed like a pin, bearish pin. And these two subsequent lows have not broken 35.85. So my stop loss wouldn't be 10 pips above the high, 35.67. It would be just above 35.85, let's say 5 pips above. So that is called also dead stop. This is the way you should place your stop loss. If you use indicators such as pivot points or daily support and resistance levels, and you trade daily charts, you need to place stop loss not just above the last high, it's above the last high important level. In this case, it's 35.85. If you're trading on 4-hour time frame, that is okay. If you're trading on 4-hour time frame, we need to see a candle configuration. If you can see that this candle hasn't broken this high, this is 4-hour time frame. You see? 35.70. Is it 35.69? Yeah, that is 35.70. So if this candle hasn't broken this high, and this high, and this high, we assume that this also 4-hour candle will not break through this high, 35.68. So we can say that our stops can be 5 pips above this level, technically. Because 1, 2, 3 candles hasn't broken that 35.70. Right? Let's say that now we are zooming into 1-hour chart. Many systems which you use probably say place a stop loss order just above the high or just below the low. In this case, where would I place a stop loss if I trade? If I trade, let's say, this is leaving candle. But let's say for the sake of this webinar that we want to trade this level, 35.30, and we have placed a short order here. On my Practical Naked template and Practical Naked, which I teach traders to trade, this is candle configuration, which is called spinning top on a red level. That is my invention. Spinning top on a red level. That means that probably the trend will continue. This is downtrend, and this candle configuration, this is also an advanced block here, and this is bearish pattern. So if I placed an order just at the close of this candle configuration, my stops would be 5 pips above this high. It's 35.36. So I don't take into account 4-hour and daily. I take only 1 hour, because 1 hour is, there are much movements around 1 hour. So I would place order just above this high, my stop loss, and I will go short there, and you see, bang. At least it was good to the next red level for some 20 pips, and eventually it went double top. It made double top, the double bottom, triple bottom, where we can exit our trade. But also we have a nice configuration here around this red level, 35.15. We can see a nice bullish engulfing candle, and we can see bullish advanced block. And around this level or this level, if we go long, I would place my short just below this double bottom at 35.05. I can say 35.00 or 34.89, because it's also a very important level. And you can see what it happened. It went to an extra level. So basically what I'm trying to say, always use that particular time frame you're trading at. If you're trading 1 hour, don't look at 4 hours. If you're trading 4 hours, though, you don't need to look at daily. If you're trading daily, then look at daily. 1 hour daily are not the same. It's not the same. Now, what about 15 minutes? 15 minutes gives us intraday possibilities. You can see a nice candle configuration, let's say around this level. And let's say we have a hammer here around 35.30. And this is the low of the hammer. 1, 2, 3 candles. They never closed below. And what happened is the price violently got rejected off the 35.30. On 15-minute time frame, 3 pips below the last low. So if the low is 35.26, 34.22, 3 will be my stop loss. We also take into account these candles because it makes a nice confluence. You see, confluence. It's 35.25, so I would place my stop around 35.22, 23. Because probably if the level gets broken, it will collect, like in this example. As soon as 35.26 was broken, you see, bang, stop grabbing below the level. So we can protect ourselves by placing minimum stops. 15 minutes time frame, it's 2 or 3 pips below the last low. And if you're scalping 5 pips to 15 pips scalps, what we do is basically, let's say we went short around there. Then we apply the same methods, 3 pips above the last high. Last high was 35.85. This was our entry, so stop should be at 35.88 because we are scalping. We are not making trades for position. Scalping is 10 to 15 pips, so 5 to 15 pips, it's okay. So if you're trading on 5-minute time frame, we use 5-minute configurations. If we are trading 15 minutes, we use 15 minutes configurations, 3 pips above or below. If you are trading 1 hour, we use 1 hour configurations, 5 pips above or below. If we use 4-hour time frame, we use sometimes in conjunction with your levels or your support and resistance indicator. Sorry, this is Skype. So you use it in conjunction with your levels of support and resistance for indicators which you use. I choose my red levels. So let's say this is indicator for your support and resistance. So use this, or you use 5 to 10 pips above the last high. And if you use daily charts, then you go with levels. You don't use just wicks. You use important levels, not just the wicks. Okay? Now I think we got clear with these stop losses, especially these technical stops. And you should avoid to placing, if you, let's say that you are trading 1 hour time frame. And let's say that you have entered your short order here. Now you don't place your stop orders around there or there. You place it above this, because this was the last important high. So if you have opened your trade around there, you won't place your stop here, here, or here. It will go 5 pips above this level. Well, at the last important higher high. If you place it here, or here, or here, you can experience death of 1,000 cuts, because the price can go over like this. Never touches your proper stop loss, but indeed it collects your weaker stops. And you will get sliced. Okay? Now I think if anyone has any question, do not hesitate to ask me. I will answer it. If you don't have any questions more, we can conclude this webinar. What are your thoughts of combining buy stops and sell stops using no stop loss at all? I don't do that. I don't do that because I have my own this is the way I teach, and this is the way I trade. I use these kind of stops as I explained. If you combine just buy stops and sell stops, you can go in a whipsaw trades. Let's say you open your trade around there, and you have also, this is ranging market, and the price goes like this. That is improper hedging. And what can happen is in the ranging market, let's say in the ranging market, let me give you an example on this PowerPoint slide. On a ranging market, if it goes like this, what is this? If your buy stop has been open there, and your sell stop has been open there, what can happen is you will get whipsawed. How you use proper hedging? You need to close this trade in order to be profitable with this long. But if this long goes here with 5, 6, 10 pips of profit and you didn't close it, and then this trade here will go in a big loss around there because you don't have a sell order here, because you have already closed it at the second break of this high. So that ranging market can kill you. This is the most annoying thing. That is why I don't use it. Where do you pick that tool on your charts for getting instant pip count between 2 points? This tool is. This crosshair is called crosshair, like in first-person shooter games, if you play any games at all. Crosshair is like your target, you see, and then you drive it always. I always do it from the left to the right. So you see here, this first thing is called candle count. The second tool is pip count, and the third thing is the level. So if you go from here to here, this is 6 candles. You see, the first number is number of candles, the second number is number of pips, and the third number is the price level. What other tool for a pip count? You mean, maybe you think about this. Again, crosshair, but I look to the left. I don't know which other tool you means. Now you know something about Darsh. Now you know something about the platform. It's okay. Yeah, you can. Many traders don't know that this first number represents the number of candles for that particular time frame, and that is good if you want to. I also, when I do breakout trading from time to time, I look at this candle count tool for my. It's called. How can I say it translated to English? Buffering zones of support and resistance. That is why I often use this candle count tool. Late starter. I think that this webinar is being recorded, so I think that you will be able to watch it later. I don't know which other tool. Crosshair is this. I use it for pip count. And this is also how I see the lows. If you place your crosshair here to the bottom left of this MetaTrader 4, you can see data window. So you can see open, high, low, close, whatever you need for a proper trading. There is, I always use this crosshair, so for a pip count. Okay, if you have any other questions, you have. Back to my questions. Proper hedging can help to unlock ranging position or at least minimize losses. No, 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 and no. Proper hedging, yes, if you combine euro-dollar with dollar Swiss. Let's open dollar Swiss. Now let's use main template, and my divergence. So what does it say to you? You see, when Swissy goes up, Euro goes down. When Swissy goes up, we look at this. When Swissy goes up, Euro goes down. That is called proper hedging, and it can help you minimize losses. It's the very truth. Proper hedging can help you unlock positions and minimize losses, but you know to know the ranges of hedging pairs. So Euro dollar and dollar Swissy are hedging pairs for most of the time. Okay? What I would say is, don't hedge like this. Because if you hedge the same currency, in this case Euro dollar, if you, let's do it again. If you, for example, use this, sell, stop, buy, stop, and the price goes like this, you will unlock this, you will let this run, but you will probably close short. But what happens is, in the ranging market, this can go down, and now you don't have a sell position around there, so you're doubling the loss. Use Euro dollar and dollar Swissy if you want to hedge. Right-clicking on crosshair. Let me see. No, it only gives you to customize the crosshair, you see, or this bar here. I just use it with left clicking, left click and left click. But if you click the crosshair, just use the left mouse button to show you pip count, not the right mouse number. The right mouse button. The left mouse button, if you click the left click the crosshair, then left click, let's say, the height, the pin bar, and then hold your left mouse button and count the candles and pips. You need to hold the left mouse button. And now if I right click it, this happens if I right click it. Maybe it's on your configuration, it's very, very strange. If I right click it, this is what happens. I lose it. Can we use double the opposite trade for hedging? No, that is called doubling your position, or if you go with Euro dollar and you open $2 or $3 cross pairs, you are exposed. That is called double exposure. Don't do that. Left button, yes, left button. No, you are welcome. Okay. Avoid trading double exposure. If you're going long on Aussie, and if you're going long on Aussie dollar, and let's say on I don't have it now, this is demo account, but I have it on my live account, Aussie dollar, Aussie yen, or other Aussie crosses, you can combine it, but don't combine just dollar crosses, because usually Aussie dollar cable and Euro will go in the same direction, usually. Now Aussie is very, very strong. That is why it goes to the upside. And that is why I told you to go long on Aussie, if you remember my last webinar. So basically you are double exposed if you trade only dollar pairs. Okay? Okay, guys. Now I think that you have learned quite a lot from this webinar about placing stops. If you're not sure, you can always watch this webinar again. Is dollar yen better to trade than Aussie Swiss? Yes. For me it is. Aussie yen is good because usually on a bad dollar, Aussie yen goes, if news for dollar are bad, Aussie yen goes up. Because yen is also considered as a safe haven. Okay? Okay, guys. Thank you also. Now, today we will see what will happen about trading our currency pairs. But tomorrow, of course, expect a new analysis. Also, we will have a nice webinar tomorrow. Be sure to sign up. Let me open a sign up page. Though this site is also good, Forex Live. This gives a nice fundamentals and live fundamental views for Forex markets. This is Thread. If someone of you missed my analysis, this is today analysis. You can also have it on Admiral Markets. Here is, I will show you my screen now. This is Admiral Markets. This is my blog on Admiral Markets and daily analysis euro dollar for October 16. What did I say? As we could see, yesterday buying around 34.85 has been fruitful as the price has jumped some 45 pips. Just for the sake of current day's analysis, I still see buy the dip possible around 3.500 to 34.80, and of course 34.50 if it gets there. You see, stops go at 34.70, guys. Stops go 34.70. Of course, you need to include the spread. You look at the low, 34.71.9. What does it say? Admiral Markets is honest broker. It doesn't cheat. Look at the screen, low, 34.71. It means that if you have longed around 34.80, let's say, or 90, your stop wouldn't been hit. And look at the price. This is also important. Look at the low. Look at the bottom left of my screen. Look at here, low. It says 34.71. You see, some brokers will spike your stop loss. Let's say that your stop has been 34.70 and 1.5 pip spread. That gives us 34.68, right? Some brokers can spike the stop loss and get you out of the trade. And this is one of examples that Admiral Markets is honest broker. Look at this. 2 pip saved from the stop loss. Considering this analysis. Okay. And what I want to say is education, webinars. Webinars, and tomorrow we will do trend definition at its best. We will show you what trend is, how to determine a trend, what multiple time trend is, time frame trend is, and to give you a nice example of entries if you're doing the trend trading. So be sure to sign up for tomorrow's webinar. Thank you very much, guys, for attending this webinar, and do not hesitate to ask me anything because there are no stupid questions. I told you that. Just keep on asking. I will tell you everything I can and know. So thank you again, and thank Admiral Markets for giving us the possibility to explain to new traders and advanced traders these kind of things. And thank you all for attending my webinar today. I wish you a very well day and very pleasant day and many green pips to you. Bye-bye and talk to you tomorrow.
The organizer